Hello, everyone, and welcome to today's episode of the Macrocast. I'm your host, Ylan and Managing Director at Penta. My co-hosts are John Fagan and Brendan Walsh of Markets Policy Partners. Also joining us today is our good friend, John Dick, founder and CEO of Civic Sciences. Hey, everybody.
Hi, Ylan.
Hi, Ylan.
Hi. Well, I have to point out that we are taping this episode on Friday, the 13th of October. And unfortunately, that actually feels almost too appropriate because there are a lot of really frightening things happening in the world right now, including what we're seeing happening in the Middle East, the ongoing war in Ukraine. JP Morgan has released its earnings, and we're going to talk about those in just a little bit. But what has been grabbing headlines is CEO Jamie Dimon calling this moment the most dangerous time the world has seen in decades. And it seems like that unease is starting to trickle down to ordinary households. John Dick, what are you seeing in your data? Because you really have the pulse of the consumer.
I mean, it is indeed trickling down. As you know, we released our economic sentiment index numbers this week, and they predated, at least the most recent release, at least predated the events in Israel earlier this week, and they were already down pretty dramatically. We're seeing the ESI is at the lowest level we've seen it in a year. Again, predating these events. I just looked at the numbers this morning. As you know, we're tracking this stuff kind of in real time, and consumers' outlook for the U.S. economy, just as one sort of bellwether, is 5 percentage points worse than it was at the beginning of the week. It's hard to assign absolute causality to something like that, but it would be an unusual coincidence for to see that number drop that quickly in that short of a period of time. I think it's safe to assume the events in Israel had a significant impact on that.
John and Brendan, what are we seeing in terms of financial market implications?
So when you look at broader markets, one of the things that sticks out at you this week really is this sort of counterintuitive rally in stocks. And that really clashes with, the negative headlines and the bad news. But really, in some sense, it appears to be a consequence of the recalculation in Treasury markets of the Fed's hiking trajectory. It's the old classic post-global financial crisis formulation of bad news is good news, in that, we saw last few weeks the 10-year Treasury yield just rocketing higher, and real concern about what was driving it. Maybe it was not just, this higher for longer formulation, but something, a rebellion over deficits, something, more structural. That was very disquieting to equity markets. But we saw in the face of the terrible news that we saw last weekend, Treasuries staged longer dated Treasuries staged a significant rally over the past few days. I mean, they're down 20 basis points on the 10-year from the peaks that were put in last week. And that's proven very reassuring to stock markets. The Treasuries are behaving the way that they should behave, as a safe haven. And on the margin, you're seeing expectations in futures for the Fed fund rate not to go up anymore. That's now very much the base case. And the Fed's, despite the fact that the Fed has been threatening more hikes and a slightly more dovish outlook. So we get these kind of, the sort of stimulus response in equities from this Treasury rally. But, on the broader scale, it's really hard to see anything getting better in the world over the medium term.
What are we seeing in the oil markets? I know that consumers had recently been enjoying a little bit of breathing room as prices at the pump came down, but could this cause instability that hits the pocketbooks once again?
Yeah, we've been, and the inflation data that came through this week again showed that persistent pressure in energy prices, oil prices, and so forth. We'll talk a little bit more about that. But, we've seen, unsurprisingly, oil markets swing pretty dramatically this week. They haven't been, unidirectional. They haven't just been rocketing higher. They popped up on the news, obviously, but there was a sense that, if this is contained, then it's not going to be such a significant threat to supply. But, everybody's looking kind of toward Iran and saying, if they're implicated in this, then, that is potentially significant in terms of supply disruption. And certainly the prospect of a wider war in the region is, creating that additional geopolitical risk premium that we're seeing in Brent and WTI. So it's not surprising that they're supported. The announcement of tightening sanctions on Russian oil and energy by the White House also boosted oil prices. So it's kind of, as these dynamics have, the fears of a wider war have sort of waxed and waned over the week's time here. So we've seen that driving a fluctuation in oil markets, but it wouldn't be surprising if they're, biased higher significantly, perhaps in the near term.
Yeah, and I thought the timing of the sanctions was obviously they've been playing this for a long time, but, it shows kind of how serious the Treasury and the administration is about keeping this $60 price cap on oil exports, because I couldn't have picked a worse day to, if you didn't want oil to go up, today was not the day to put out sanctions on Russia.
John Dick, you had mentioned that the ESI, that economic sentiment index that Penta and Civic Science put out together, that was already at an incredibly low level even before we saw the recent flare up in the Middle East. What was holding back consumer sentiment even prior to this? I mean, is it just the dysfunction that we've been talking about for weeks now that's happening in DC? Is it still hot inflation, as we saw in some of the economic data this week? What's going on?
Well, I mean, we'll give it a little bit of context. So, I mean, it's the worst it's been in a year, but it had largely sort of improved in the first half of the year from low points of last year, when sort of inflation was running at its hottest. So we're not quite back to that worst state yet. But I mean, look, just because quote inflation rates have gone down, that doesn't mean the price of goods have gone down. People have continued to put more and more purchases on their credit cards at super high interest rates. The job market's tightening a bit, at least at the sort of middle to upper tier of the job market. We've got student loan debt returning this month. There's just a lot of, kind of things weighing on the consumer. We're seeing a significant uptick in the use of things like buy now, pay later programs, particularly for even we watched yesterday. We just published some data yesterday on some research we did during the Amazon's Prime Day, whatever they called it this year. And a significant increase in consumers reported using buy now, pay later services for their Amazon Prime Day purchases. So there were already a lot of things just beginning to weigh on the consumer going into the holidays. So, I mean, pick any one of those things and it helps to explain why we've just seen a downturn. Again, just to give it perspective, we're not quite as bad as we saw, say, this time last year, but it's definitely trending in the wrong direction. And something like what happened this week is only going to probably push it further down.
My very first job in business journalism was covering retail. And so I followed retail sales numbers very closely and have a soft spot in my heart for that data. And one of the things which appeared to be an emerging trend, or maybe it had been ongoing for a while, but it was new to me, was this idea that maybe Halloween is a bellwether for what Christmas and holiday spending is going to be like. Do you have any data yet on what folks are spending for, the end of this month, and then any outlook for what that means for Christmas?
We do, and it's going to sound, it's pretty counterintuitive. First of all, Amazon Prime Day participation, whatever it was, Tuesday and Wednesday, was up 25% over the same period last year. So people showed up to spend. Now, are they doing that because of the economic headwinds or in spite of them? Obviously deal seeking is a high priority for people. We know the internet is a deflationary tool. So people are maybe getting a little bit of an early start, seeking out those deals. A larger percentage of those shoppers said that they came to the Prime Day event with purchases in mind, meaning they weren't sort of window shopping compared to, say, years past where there was maybe a higher percentage of like impulse buys that were made. So it was more premeditated, which says, I think, the consumer's being calculated about their expenses. But look, for better or for worse, it looks to us like the holiday retail season is going to be pretty much up to the par with what we saw last year. Maybe consumers are whistling past the graveyard or harboring some optimism as at least it relates to their personal finances to plow through a holiday retail season and continue to splurge like we've kind of grown accustomed to the last 2.5 years. Maybe if that happens, we should expect the chickens to come home to roost pretty hard in the first quarter of next year when those holiday credit card bills show up and home heating costs are presumably through the roof. So, right, for one reason or another, the consumer is just being very resilient as it relates to their spending. In the aggregate, there's certainly different categories that are, they're trading off and trading down in, but no, I think at a top line, there's no reason right now in our data to think that this holiday retail season is going to be particularly down.
Did you guys get any deals? Most important question.
I did not.
Did you guys
I
shop?
didn't even have.
I missed it by a day, but I still was able to secure some, I think it was maybe 20% off body art markers for my daughter. At what I thought was a steal. So, that's something there.
The big category this year was electronics, home electronics. That was sort of the top category people bought in during those days, followed by like home goods and things, which is interesting because a lot of those larger goods manufacturers have been wrestling with a change in their purchase cycles because during the peak days of COVID, everyone bought a television, everybody bought a home appliance, and it kind of jolted what had been very predictable cycles of purchase cycles of those larger ticket items. It basically every 5 years somebody buys a new TV or whatever, and then it got jolted, and so people were wondering when that would people would start buying again, and there's some signs of that. Which is, I guess, is good for some of those larger appliance manufacturers. But yeah, it's bucking what would be the conventional wisdom of how the consumer should be spending their money right now. They're just they're barreling through it.
Yeah, just added to one of the many pieces of conflicting data that we see in this economy right now, right? Where there are lots of headwinds and there's lots of perhaps angst, but when it comes down to it, consumers are still pulling out their wallets.
Well, I was going to say, look at the iPhone 15 sales. I mean,
how are they doing?
Tremendous. I mean, that's a big ticket item, right? That's a $800+ phone, and people, they're quote shattering sales records according to the clickbait headlines on the topic. So you would have thought that might be something people would maybe stretch their current phone another year or something, but no, iPhone 15 sales aren't suffering at all.
I still have an iPhone 12 mini, so I'm due for an upgrade sometime soon. But, I wonder, you mentioned how consumers might have a problem with the credit card bills that come due in January, especially when you think about the fact that we're not really seeing a whole lot of deflation, right? We're just seeing maybe a moderation in the rate of price increases. The CPI came out this week as well, and it was a little bit hotter than investors had expected, particularly because of all of the costs of housing that continue to rise.
Well, housing and I guess fuel as well was just that's sort of the two main drivers of that. Yeah, I mean, consumers are feeling that, no doubt. I mean, we even in the analysis that your folks wrote up for the ESI this week sort of mentioned the housing market again, and it didn't fall as bad as some of the other components in the index, but there's not much more room for it to fall. It's sort of just bouncing along the bottom, and obviously that's something we saw. Just more data we published this week about something that some upwards of like 2/3 of people who say they would otherwise be in the market to buy a new home are just sitting it out, right? They're going to stay where they are or rent, or just delaying, right? So consumers are, it is a bad time to buy a home right now, and also a hard time to sell one because no one wants to buy at whatever 6-7+% interest rate. So that's just where we are.
Yeah, and the inflation numbers this week, the market has has taken them in stride to a great extent, and we have seen a pretty significant, as we mentioned before, that significant Treasury rally has survived the upside surprises that we've seen. And again, it's that same theme of the headline going up, lifted by those more volatile food and energy prices, and to specifically energy, and that's. That is something that the Fed really hasn't weighed in on, to with great specificity. It certainly doesn't seem, as though these numbers this week are going to goad the Fed into a significantly more hawkish stance. But there is a lot of noise in these numbers, in these inflation numbers.
Yeah, if anything, what we're hearing from the Fed is that it feels like more and more voting members are coming out and saying, we can hold rates where they are because we've seen that big swing in the Treasury market.
Yeah, absolutely. And of course, that kind of talk actually, undoes some of the
Stop talking, guys. Stop talking.
Yes. So it is it is kind of circular in some ways, but yeah, it's going to be a constant communications challenge for the Fed. To remind the market, even if we're not hiking rates at the next meeting or the meeting after that, that doesn't mean we're in easing mode. And, that is just always going to be, particularly if the consumer does begin to tire out here in the second half, in the back part of this year and into next, that is going to trigger once again an expectation in financial markets that the Fed is going to be cutting rates by the summer. We've seen those odds creeping up again, and that is really going to be, something that the Fed is going to have to message around for sure.
Yeah, it's interesting. There's been a little bit of disconnect, I feel, because if you look at the Fed's most recent dot plot where they lay out what their expectations for where interest rates will be at the end of the year, it looks like that they were still pricing in or still expecting to do maybe one more rate hike, right, before 2023 is over. But now when you look at Fed fund futures, it looks like markets are pretty much saying, there's no chance they're gonna hike before we get to 2024. And in fact, as you're saying, John, maybe there's a possibility that they start cutting in the middle of next year. So I think it's really a difficult place for the Fed to be in when it's relying on the market to do its job for it. But, how long do rates need to remain this high to give the Fed confidence that actually it doesn't need to adjust its own position to accommodate what the market is doing?
Yeah, the Fed, they're just not going to know when it's going to be such a difficult thing for them to know where that, as they've admitted, where's that neutral rate? And it's a real guessing game. And the expectation that we have is that the Fed errs on the side of staying tight. And the fear of reawakening the inflationary spirits, particularly with persistently elevated energy prices, is going to keep the Fed, on hold and, potentially communicating to markets about possibility of additional rate hikes, even when, they probably in their heart of hearts don't think that they need to. It's going to be we think it's going to be a really tough environment. And it's not just the Fed. We think that the European Central Bank and Bank of England are going to be in a similar, sort of mode where they're, it's a quasi-stagflationary, if not outright stagflationary kind of dynamic. And there are just no good answers necessarily. So they'll probably choose inertia rather than action in the face of that conundrum.
Yeah, we heard it from Vice Chair Philip Jefferson saying he's remaining cognizant of the tightening in financial conditions. Dallas Fed President Lori Logan said that there may be less need to raise the Fed funds rate as long as long-term rates are elevated. And then we also heard from Philly Fed President Patrick Harker saying that very explicitly they can hold rates where they are. And he's a voting member this year. So, it seems like there's consensus building. But again, there's the catch-22 of if they say this, then maybe markets sort of ease off, and then the Fed will have to actually eat its words.
Yeah, and I think part of the commentary from the Fed this week was what we talked about last week, that when rates move this quickly, this high, there's a chance for something to break in the financial system, and they certainly don't want that to happen.
Well, Brendan, one sector of the economy that's benefiting from higher rates is certainly the banks, and we saw that in JP Morgan's earnings that were out today.
Yeah, so JP Morgan, Citi, and Wells Fargo all came in above expectations, and it was entirely on their net interest margin. So they're lending at higher rates because rates are up, but their charge-offs, so people not paying their bills back, it has kind of stayed steady. So their earnings are much higher than kind of consensus expected. So in terms of the near term, or the past, things were pretty good in the last quarter, though the commentary was a little more cautious for the future. And it wasn't specific to any bank, but you mentioned Jamie Dimon. It was, there's wars going on and there's a lot of uncertainty. And we're coming off a year where we grew, a little above expectations. So, there's always that chance that as we talked about earlier, that the consumer pulls back and they've kind of spent a lot of their excess savings. So the banks are in strong shape. They're earning more than expected, and most importantly, the charge-offs are down. But there's definitely caution on management's side that they're not saying it's off to the races.
Yeah, and when you think about the global economic outlook, the IMF and World Bank are holding their annual meetings, I think this year in Morocco. And as part of that, they issue an annual forecast. And this year, the forecast actually for 2023 remained unchanged, 3.0%. But the forecast for 2024 actually came down a little bit. And a lot of that was based off of what's happening in China and the concerns about whether or not the sort of rocket ship of growth that they were able to achieve, pre-pandemic is really going to be able to hold steady. And I think the answer is no, it won't.
Yeah, even just this morning we got data. So that their inflation numbers were flat, which we're trying to bring inflation down. They kind of want to push it up. They don't want deflation. And their balance of trade was lower than expected, both on imports and exports. So the export engine of China isn't really running right now.
And the pressure from Beijing to try to deliver on their promises of growth, we've seen a patchwork of stimulus, but not the massive campaign style stimulus that we've seen in, within the last decade or so, whenever the leadership would decide, up until probably about 2016, they would always just have this massive splurge and it would go right into property investment and kind of deepen that problem. So we're seeing a more cautious, more diversified style of stimulus, trying to give the consumer a little bit more pep and trying to give the stock market a bit of a boost by changing some of those and hopefully trying to help sentiment. But it hasn't really delivered. Although we've seen some of the recent data has spoken to a degree of stabilization to reacceleration, but it certainly isn't a massive change in the direction of this economy.
Yeah, earlier this week there was kind of reports out of China that they're going to expand the deficit to above 3%, and the market just kind of whistled by the graveyard on that one.
So it seems like we're in a place now where the U.S. is really, despite all the challenges that we have here, as we've been watching a lot of the drama unfold domestically, but that the U.S. is really the strongest part of the global economy right now, and we see other economies, China, even the EU, being weaker in 2024.
That's the story of U.S. resilience, and it's really boosted the dollar. The dollar is at near cycle highs here, and has really been taking the lunch money of the yen and the renminbi. It's
how much weaker can the yen get?
Well, they're definitely in sort of a controlled descent mode. Yeah. There's a lot of job owning, but in the grand scheme of things, Japan is still, you look at the interest rate difference. They still haven't hiked rates. They're still at negative 10 basis points for their policy rate, right. Whereas every other central bank has jacked up their policy rate. So it stands to reason that the yen is very weak, but sort of the defense of it has been maybe a little half-hearted. And a weak yen really isn't a bad thing for Japan, obviously, if it gets too weak too fast. But they still have concerns about deflation like the ones that you mentioned in China. That's why the BOJ the Bank of Japan has not hiked rates. They still say, when we look out, we still see in the medium to longer term the deflation risk coming back. And so, it's a very different picture, and great time for a holiday in Japan. If you've never been, it always had this reputation as like Tokyo is the most expensive city on earth. Well, those days have gone by after 2 decades of like flat CPI, zero inflation, and a yen that's tumbled down to multi decade lows. So plan your vacation now, I guess.
Maybe that's the Christmas gift that your family needs, John.
And now I sound like a spokesman for like a Japan Tourism Society. You can send
this is not Fagan. You sound so much smarter in that suit and tie. It's unsettling looking at you on a Friday morning.
This is the benefits of being on a podcast.
They still fit.
No, this is not a sponsored pod, guys. I will say that, at least not by Japan's tourism board. But John Fagan does look quite nice today. Thank you, John. So lots of global headwinds, lots of uncertainty here at home. But what are you guys watching out for in the next week?
President Powell has a big speech later in the week. We haven't kind of heard from him lately, and certainly not after all the events of this week. So that's definitely going to be an important event. And then we also get retail sales, which, is kind of the third most important data point. But John Dick already told us what they're going to be, so we don't need to.
You heard it here, folks.
One thing we didn't mention that is showing some cracks in retail is the retail theft problem, and then the general sort of implications of crime in certain areas of the country that are what that appears to just be doing, though, is shifting a lot more shopping to online. It's going to be a massive e-com holiday season. That was going to happen anyway. Again, as we said earlier, online commerce is sort of deflationary for the consumers, so they can find deals that way. But also, if there's any trepidation about walking into a store, all the more reason to do your shopping online. It's interesting times.
And John Dick, just to clarify, you're talking about old school theft, right? People coming into the store and literally stealing merchandise versus
absolutely,
versus cybersecurity or
totally.
online counterfeit goods, etc. Yeah,
people absolutely stealing from stores. It was in Dick's Sporting Goods earnings. It was, it's almost like a new line item in their earnings report. I forget what exactly they have a vague term for it. I forget what it's called. They attribute it to obviously the loss is associated with theft, and it's a real thing. Incidentally, one of the things that appears to be driving it is the proliferation of self-checkout, because it just makes it easier for people to not scan every 10th.
You were on camera, item. People. You're still on camera.
But it's apparently those cameras aren't thorough enough, I guess, or maybe those people just know not to come back to that store after they've raked it for whatever they've stuck in their bag without scanning it. But it's a definitely emerging problem, and again, also driven by economic hardship. Right? We just see people who are trying to make ends meet are more inclined to cut corners, legally or otherwise.
Sure. Well, I think that's a place to leave it for today. Thank you, everybody, for joining us. That does it for us. I'm Ylan Moy with Penta. My co-hosts are Brendan and John from Markets Policy Partners. John Dick of Civic Science also joined the pod as well. We hope you enjoyed our show. And please remember, you can always listen, like, and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.